In terms of questions that have come through, Pete, perhaps one for you, just kicking off on the back of the discussion around local stocks. A couple of questions around Sasol and whether we see that as an opportunity.
Yeah, so Sasol is a very interesting one. If you took the recovery in the global economy that the bond market in the US is implying and what the stock market's implying, you would expect oil to come back. A very positive sign last week was OPEC getting back together and stopping their spat and trying to compete with each other over bigger and bigger volumes. And that will support the oil price over time. To put it in context, the oil price came down from about $50 to half of that, to $25. That's unsustainable, and we think you'll see some more actions from OPEC. But at the moment, there's about 100 million barrels of oil supply and only about 70 million barrels of oil demand. And hence you're seeing the price off significantly. When the world returns back to normal, we think that'll kick back, and the 10 million barrels that OPEC has just cut becomes a significant cut if demand starts to come back somewhat. So that's our kind of picture of oil. There's some sort of doomsayers, Goldman Sachs predicting it going down to $20. Sasol itself has got other issues. They spent $13 billion on investing in a plant in America, and that's roughly what they've got in debt. So if oil stays low for a long time, Sasol are going to have to raise some capital. If oil kicks back to reasonable levels within the next 6 months, they can get through without raising capital. So very simply, there's a lot of detail underneath this, but if Sasol doesn't have to raise capital and oil comes back reasonably, we think the share can be worth 200 Rand a share again. If they do have to raise capital, so if you've got 50 or 70 Rand or wherever the share price is that you invest, you might have to put another 50 Rand in to participate as a shareholder in shoring up their balance sheet, which then means that you've invested 100 Rand instead of 50 Rand to get to your upside of 150 to 200 Rand. So in summary, there's a lot of optionality in the share, but it is high risk. If oil stays down at $25 a share for an extended period, the company can get into a lot of trouble. We have owned it in our portfolios, and we've kept it because of the optionality. But for new investors, you've got to understand that you're taking a risk beyond a lot of the other companies that we've indicated in this presentation.
Ladies and gents, we've got a large number of questions coming through, so we'll try to run through as many of them as possible. The answers might be a little bit short, but just bear with us. We'll try and give our views as best we can. Nolan, perhaps one for you. What do you see as the anticipated impact of COVID-19 on the SA economy? And are we able to survive this without an IMF bailout?
Short answer is I do think we survive it without an IMF bailout. The consequence of this is that the South African economy through 2020 is likely to shrink. It's going to shrink by between 5 and 6% based on the estimates we see. Unfortunately, that is actually quite catastrophic for the Fiscus and National Treasury. Get to that in a second. But it is more important probably how the economy behaves in 2021, where we're seeing vastly different estimates of the recovery profile. So the IMF yesterday was talking about the South African economy growing by 4% in 2021, which would almost repair the damage done this year. Conversely, if we look at some of the other analysts, we're seeing projections of growth of only 2% next year, which means the recovery takes a lot longer. That's the big uncertainty that we're all wrestling with. The challenge for the South African National Treasury is that our government is running out of money. And we've already seen the stresses from that. We saw in the budget that the government's starting to make very unpopular, very difficult decisions because they don't really have a choice. The consequence of COVID is that the government's tax collection this year is going to be materially less. And basically the runway that the government had to deal with the difficult challenges has shortened dramatically. So what we are likely to see is the difficult choices are going to need to be made sooner because of this virus. Prime example is yesterday where the Treasury and Minister Pravin Gordhan refused additional funding for South African Airways because in the context of what's happened, there just isn't availability of funds. So we actually take the government's response to be quite positive there. It looks like they're accepting the belt tightening. It looks like they're making the changes they need to make. But absolutely, I think that the economy is going to be in for a very tough time, and the national fiscus is probably going to bear the brunt of it.
Thanks, Nader. We've got a general question. I think, Peter Little, you might be able to start with this one, around government intervention. What are the processes, what are the mechanisms for government to step into the economy? And what is the sort of trickle down to the affected people? So I think the question is around the mechanisms of government intervention and how does that actually impact people on the ground?
Yeah, so I'll start off with what's happening globally. So you've seen, as I said, the US have injected about $2 trillion worth of stimulus into the economy, and that's through a broad range of measures. So you have some low and middle income earners receiving a check directly from the government. So you received, I think it's $1,200 for each adult and about $600 or $800 per kid. You just get mailed that directly. So that's stimulus directly to the individuals. Obviously, the hope is that those individuals go out and spend that, and that creates economic activity. You've seen things like government stepping in to guarantee loans to small businesses. So there's a vast range of measures that can be achieved. I think, fortunately, this time governments are very focused. In the previous crisis, the governments had to throw all their ammo at the banks just to keep them functioning as the sort of center of economic activity. And as I said, this time we don't seem to have that problem. And the governments, I think, are targeting particularly small businesses, which are a significant employer of people, because what you don't want from this crisis is for a lot of people to end up unemployed. And if we looked at the stats in America, about 50% of people are employed by companies that have less than 20 employees, and about 70% are employed by companies that have less than 100 employees. So the small businesses are critical to maintaining employment, and both in South Africa and globally, we're seeing governments trying to target stimulus directly at that, and I think that's a great effort. And then both here and globally, we're also seeing governments stepping in and using their unemployment benefits, extending those to a broader class of people who become eligible for those, and extending the amount of time people are able to claim from that. So those are kind of the broad measures. I think making sure people, as Dr. Enthoven said in his speech, have the capacity to do the bare essentials, buy food, keep themselves with a roof over their head. And then we want to make sure that small businesses are still able to come out the other side of this operating and able to employ in significant numbers so that we don't have a jobs crisis.
Thanks, Pete. We've got several questions coming through around listed property and Anchor's views on that sector. I'm not sure who's closest. Maybe Peter Armitage, you can kick off.
Yeah, listed property has been an interesting one. We put out an opinion piece about 2 or 3 weeks ago, indicating that we felt there was significant value, but pointing out the frailties in the sector. Maybe just 1 or 2 points on where they find themselves. Listed properties in South Africa on average have got about 35 to 40% gearing. In other words, if they've got 100 Rand of asset value, they've borrowed 35 to 40 Rand. What's happened is that asset value has definitely dropped. And this really had started probably before COVID, but particularly for retailers, they're facing the prospect of a time period without any rental income. So if that 100 Rand of value has gone down to 70 or 80 Rand, the gearing levels are too high, and they're going to have to manage their way out of this situation. So for a lot of the listed property companies, they're in the hands of the banks, and the banks will cooperate with them because they've got massive loans into the sector. And I think one has to be very stock specific. So if you go through the listed property companies, there's definitely property companies at the bottom end of the quality range who are going to face significant non-payment from tenants, and they're not going to survive through the whole crisis. There are some much higher quality businesses, which, if you take 20 or 30% of their turnover away, can still survive. I was on a Vukile presentation a few weeks ago now, I was doing some basic calcs where they could basically, they said without any rent, they could still survive for another 12 months. With rentals down about 25%, that hit about 60% of their earnings. So property companies came off precipitously, many years down at 60 to 70%. I think property companies are worth less than they were before this crisis, but the high quality ones probably worth 10 or 20% less, not worth 50 or 60% less. So that was the view 2 weeks ago. There's been a massive bounce in the last few days. Something like a Growth Point got down to just over 10 Rand, is now sitting at closer to 15 Rand. I think one of the big issues and one of the big unknowns is whether property companies will pay dividends for the next 2 years. There's a fairly high chance that those are cut or zero across the board for a 12-month period. The Property Association has put out various pronouncements. So I think one should build that into one's expectations. But not paying a dividend doesn't decrease the value of the business. It's just being kept within the business as opposed to being distributed to yourself. So for people who've got a high level of interest, we've also got a big property team. We've got a property newsletter that goes out every morning. So pop us a mail if you want to get onto that. But I think we quite liked high quality property companies going back 2-3 weeks ago. They bounced quite a lot. I think I would expect some consolidation at these type of levels. What I haven't mentioned is the obvious one is interest rates coming down. And that was a big driver for them kicking yesterday. Because obviously the debt levels in the businesses, they're now paying 30% less interest than they were a few months ago.
Thanks, Pete. Just to reiterate to everyone out there that we do produce a high volume of research and comment both on share specifics as well as macro and microeconomics and general thematic pieces. If you'd like to receive any of that, please visit our website. You can subscribe to various newsletters there. And alternatively, you can send us a mail at invest@anchorcapital.co.za. Back to a few questions. Just a general question. What's driving the recent bounce we've seen off lows in March? And what is our outlook? Do we expect the sort of bounce to continue? Is it the beginning of another bull market? Or do we think that there's another leg down?
Well, I think I'd like to think we've covered that view and Pete can add to this in the presentation. We think that the market's bounced back too quickly. It's almost impossible to predict the next month or two in global markets. But as I indicated, for me, the US is almost back to fair value. So my personal expectation would be volatility to continue and some more downside to follow. So hence we're exercising some caution. Pete, do you want to add to that?
No, I think, as you say, we've pretty much covered that. I think there's still a number of uncertainties out there. We see a lot of the large economies coming close to peaking now. We don't know how quickly they're going to recover, and we don't know if there will be new incidences of this coronavirus spread down the line. It's not like it goes away after it's recovered the first time. So there's a lot of those kind of uncertainties that are still out there. As I said in my presentation, there's even once the restrictions are lifted, people's fears and anxieties can prevent them from getting back into parts of the economy like the leisure and entertainment sector, which means that there's a very real impact for jobs and economic activity going forward. So we just think that there's still a lot of uncertainty that has to be dealt with. Obviously, we're encouraged by the stimulus that the governments have thrown at it, and that's certainly part of the reason we're seeing the snapback. But as Peter Armitage said, we see some more volatility ahead before we know exactly how this all plays out.
Thanks, guys. We've got time for perhaps one more question. There are a couple of general questions coming through around Rand hedges and sort of general asset allocation. What are our views on bonds versus equities, local stocks versus offshore stocks? Perhaps we can just sum up by giving our view on sort of asset allocations. Obviously, it's very fluid at the moment, but perhaps that's a nice place to end off.
Nolan, do you want to take a turn?
Thanks, Peter. In terms of asset allocation, I think the point that Matt made is probably a good starting point. It is very fluid, and market prices on bonds, equities are moving by multiple percentage points every day. So what looks like a good idea today, tomorrow might not look like a good idea, or potentially it's already repaid you in some cases. There are, however, certain trends developing. The first is, as we've clearly said, we think that the rand is oversold, and therefore, if you're investing offshore, you probably will see recovery bounce. You will see your offshore assets recover, certainly in the equity indices. However, you're going to detract from that if you're a rand investor, to the extent that the rand recovers. Domestically, we like bonds. We still see a lot of value in bonds. There were a couple of questions on what is the right time to invest in bonds. The honest, truthful answer to that was probably 2 weeks ago. You'd have got a better entry point than today. We have seen some recovery, but there is still more. There is certainly still more petrol in the tank for bonds, and I do think that we'll see a bond recovery. Domestic equities is always a difficult discussion. Peter's spoken about the listed property, and then the equity market. You've got a lot of companies that derive earnings from offshore. Those will benefit more from offshore markets coming back, and domestic equities, I think, still have a bit of an uphill battle as we work through the crisis. So it's a very fluid situation, but in the context where we're at, I think all asset classes actually have been sold off. All asset classes have good opportunities, and sometimes it's probably going to be more about the actual stocks that you pick. Pete, I don't know if you want to add to that.
Yeah, no, I think that summarizes it well. I think we've given a few share ideas. I think just to caution people that these can change by the day as conditions change and particularly prices change. So we're working with clients to get them positioned in the right places depending on the risk that they're prepared to take. But it's certainly quite interestingly. I mean, if you look at rand investors in the US market are up in the region of 10 to 15% in rands year to date. So it's a reminder of the importance of having offshore. It's a reminder of diversification. But because they're up 10 to 15%, that's where we're doing quite a bit of work to say if you're a rand investor and you've had offshore investments, the risk is probably the rand coming back quite strongly. But we will continue to communicate. This was an amazing experience for us. We did quite a bit of testing. We were worried about volumes. We had 1,300 registrations to this webinar. We've got 151 questions that have coming through. So more than 10% of people have asked questions. We obviously couldn't answer them all. I'm just sort of thinking aloud with Matt. Possibly we should, kind of circle them together and try and give people a written response to some of the questions, because there's a lot of interesting stuff that we can discuss, but we're restricted by time periods. But thank you very much. It's been amazing to see you all, and thanks, Matt. If you want to just close.
Thanks very much, everyone. It's been fantastic to have so many people on the call today. As I said, we will distribute the slides and recordings. If you're looking for comment and insight above that or beyond that, you can visit our website. We've got a lot of content hosted on the website, videos as well as written pieces. We publish a quarterly strategy and asset allocation document called The Navigator. That's just been released. It's a special COVID edition, so it covers a lot of our thoughts relating to COVID and its impact. So I would encourage you to go and have a look at that. If you would like to see how we can execute any of these ideas for you, please get hold of either your wealth manager at Anchor or contact an advisor at Anchor. The easiest way to do that is through the email address invest@anchorcapital.co.za. We look forward to hosting you again shortly, and we wish you all a safe and healthy lockdown for as long as that may last. Thank you very much.